Welcome back to the Williams Real Estate Channel. Tonight we are running through the property market update for July 2025. To kick it off, out of totality, we received 0.6% Australia-wide gains for the month. Combined regions up 0.6% and the combined capitals up 6%. For the regions, that was driven out of regional Queensland, South Australia, and WA, these strong markets, followed by regional New South Wales and VIC, and regional Tassie in decline for the month. Out of the capitals, the strongest market was Darwin for the month, up 2.2%, followed by Perth at 0.9%, Adelaide and Brisbane with 0.7%, then Sydney at 0.6%, Canberra 0.5%, Melbourne 0.4%, and Hobart 0.1% for the month. So again, strong markets are out of Darwin, Perth, Adelaide, and Brisbane, leading the charge, with Sydney, Melbourne, Canberra, and Hobart trailing behind. If we look at the last 12 months, we will see the overall market has been up 3.7% as a whole, collectively in aggregate. The combined regions outperformed the combined capitals in the past 12 months. The regions providing 5.9% growth in the last 12 months, and the combined capitals provided 3% in the past 12 months. If you look at the past 3 months, however, you'll see that the regions are starting to lose some steam, as in the last 3 months, the combined regions provided 0.7% growth and the combined capitals provided 0.8%. So capitals are starting to regain the lead. It all goes in peaks and troughs. And if we look at the past 12 months, which markets for the regions which outperformed included regional WA with 12% up in the last 12 months, followed by regional South Australia up 11.2% for the last 12 months, regional Queensland 8.4%, and the dragging markets, regional New South Wales 3.7% in the past 12 months, regional Vic 1.9%, and regional Tassie 2.4%. So definitely the leading markets are out of the regions, including WA, South Australia, and Queensland in the past 12 months. If we look at the capital cities now, the leading market for the last 12 months has been Darwin with 8.5% growth, followed by Brisbane with 7.3% growth, then Adelaide with 7% growth, then Perth with 6.5% growth. And the more subdued markets include Sydney with 1.6%, Hobart 1.9%, Canberra and Melbourne with 0.5% for the past 12 months. So strong markets out of Brisbane, Perth, Adelaide, and Darwin, and the more sluggish markets being Sydney, Melbourne, Hobart, and Canberra for the past 12 months. Now, if we look at this chart, this data out of totality, the median price points are also quite interesting. We'll find Sydney is the leading market with the highest median price point, 1.2 million, followed by Brisbane in second place with 934,000 median price point. Third place, we have Canberra, 861,000 median price point, followed by Adelaide with 843,000 median price point, Then we have Melbourne. Sorry, then we have Perth with 831, then Melbourne with 803,000 median price point. So Melbourne is currently trailing in sixth place in terms of median price point. Historically, it's typically second behind Sydney. So screaming value, definitely from a price point perspective, coming out of Melbourne, and extreme heat coming out of the likes of Brisbane, Perth, Adelaide, and Canberra with their high medium price points relative to the size of their economies and the population growth that they've received in the recent years. Now, if you've been following me, you'll be across the 18-year land cycle. I use this as our framework, or my framework is using this land market cycle, which has been happening for over 200 years. And we are coming towards a critical time frame now in the cycle. We are on that blue marker. Those that have been paying attention would see I've slightly tweaked it to the top being in 26/27. So the land market's due to peak mid to late 2026. Stock markets historically trail after the land market. So stock markets could well keep pushing on into the later stages of 2027. And if you also overlay this with the GAN decade cycle, stock markets could well continue to go strong into middle of 2027. But by the end of 27 and come 28, we're due for the next land-driven downturn where the fundamentals will change, the market will turn, stock markets will be getting hammered, commercial real estate will be getting hammered, new off the plan stock will be getting hammered, the high-end real estate will be getting hammered. So the mansions, blue chip type of stock, all the expensive stuff gets hammered historically during the land-driven downturns, and specifically in the markets that have performed well in the recent years, such as Brisbane, Perth, Adelaide, Darwin, and their respective regions. At which point the market will turn, the demand will shift back to Sydney and Melbourne, and Sydney and Melbourne will lead again in the recovery, just like what they did from around 2007, 8 and onwards in the first quarter of the current cycle up to 2017, 2018 in affordable stock, mind you. Not everything will be going well. So it is a crucial time now to get your market selection, your asset class, property type, price point right for the future years ahead, because it may all be sunshine and rainbows today, but give it 2 years and it'll definitely be a different story. 2 or 3 years' time, the mainstream herd that are not across this will end up probably learning the hard way come every end of cycle. But if you're watching this, kudos, because now's the time to be getting prepared. And if you are still looking to get into the market, there's always a market prime for growth. Be cautious of which market you're getting into, because as you'll see throughout these next slides, it's not always what you think. We'll start with Adelaide. Units. As you can see, Adelaide's away at the races, going strong, but we are in that similar point of the cycle in the previous cycle of 2006, 2007, where back in history, Adelaide units reached the top and then went through a stagnant flat period that lasted a good 10 years. So if history is to repeat, which I'm sure it will, history rhymes. History doesn't repeat exactly, but it rhymes. The likes of Adelaide units could well be hitting a top, and then future years ahead could look pretty well stagnant and flat. Similar story for regional South Australia, has been going strong in the recent years, as you can see. For houses, we like buying units in the metros, so you'll see that these charts are for units in the metros, houses in the regions, and then when we get to blocks of units, both region and metro. We don't like buying houses in the metros because the yields aren't there, and by the time you buy a house, you can buy multiple units or even a block of units. So if you're looking to build a portfolio, I like to structure it by units in the metros being units, villas, townhouses, individual or blocks, and then houses in the regions as well as blocks. Commercial real estate both in region and metro, but we typically only buy units, individual units and blocks of units in the metro markets rather than houses. Houses just don't work. The yields are too low, the prices are too high, and you're essentially overpaying relative to the earnings, which explains these slides. Houses in South Australia are charging, but doesn't have much left in the tank. Perth units is showing sign of a top, has been going strong in the recent years. In the third quarter of the 18-year land cycle is showing signs of a top. And if we look back at history from 2006-7, showed similar signs of a top and then went through this stagnant up and down subdued growth path for a good 10 plus years. So again, a market we're not suggesting to buy into. Regional WA, houses has performed well in the recent years, but is starting to show signs of cooling. We'll probably have another year or two of growth, similar to what happened in 2006-7, but within the next 3 years, could well switch off and then go through a bit of a downturn, then stabilize and then stagnate for a good 10 plus years, similar to what happened from 2007-8 to 2021. So again, a markets region we're not looking into at this time. Brisbane units await the races. Showing signs of starting to cool, but could well have another kick leg similar to what happened in 2006-7 before then topping out, and then is due in the coming years to go through another stagnant flat period similar to what happened in 2008 to 2021. So we've bought many properties in Brisbane and regional Queensland recent years from around 2018 to 2023. And personally, I mean, this is my story. Go and talk to a financial planner of whatever you're going to do. But my story is I've got units in Melbourne and Brisbane, and they're probably going to hit a top in the next couple of years. So I'll be getting them ready to put on the market to sell, pay off the debt, raise cash to then reinvest into larger assets in markets that are set for growth rather than holding them through a stagnant flat period similar to what happened from 2007-8 to 2021. Because during that same period, I could easily double my money in a bigger asset that'll cash flow better and scale up and go grow the portfolio rather than holding a sluggish asset through this pretty well stagnant flat period. So food for thought, talk to your financial planner, whoever you need to talk to. But this is my story and this is what I'm doing. Regional Queensland, again, await the races. Since 2019, absolutely started to rocket. Regional Queensland is a funny market because yes, it's booming, but it can also bust. Just similar to what happened from 2009-10 all the way down to 2019. This is a pretty well similar chart if you run it across all the towns in regional Queensland, you'll find a similar story. And the boom bust rhythm comes from capital being deployed from the likes of Sydney, Melbourne, New South Wales, Victoria into these markets in the third quarter of the 18-year land cycle. And then come fourth quarter, our mines historically kick into gear as demand for commodities grows. When globally construction property development kicks into gear, that sets off demand for Australian commodities, iron ore, coal seam gas, which feeds the construction and development of projects around the world. That demand that sets off our mining sector in the third and fourth quarter creates high-paying jobs, people with income, big incomes, such as driving mining trucks around for 300 grand a year, allowing them to buy property. Ultimately, the economic gains is received by the land market. When the market turns and the demand for our iron ore commodities, coal seam gas, coal slows down, so does our mining sector, so does land price. Not only value, but also rents. So buyers beware. If you buy now in most of the towns in regional Queensland, you could well find yourself in negative equity in the coming years. As we are obviously await the races here in 2025, come off a base of 200K for houses, now hitting 450, so more than doubled. If you look back at history, 2006-7 had another couple of years of growth, but then switched off in 2009 and went backwards for a good 10 years till 2019. So if you bought in at 2006-7 price point for that 220,000 by 2019 at sub 200K, you would have been in negative equity. So if you bought in today at 420,000, you could well find yourself in negative equity. This market could probably trough out around the 350 to 380 mark within the next 10 to 12 years. So buyers, beware. Don't get caught up in the fuss. Don't get caught up in the FOMO. I know a lot of people are charging into the likes of Townsville, Rockhampton, Mackay, but that's the danger zone. The yields might look attractive now, but the yields can also go backwards as well when the rents start to soften. So don't just rely solely on a cap rate or the rental yield, especially in regions, especially in commercial assets, because if the market goes through a downturn, which if you study history, the probabilities are there. And if you even lose your tenant or if the rents have to be reduced, that'll ultimately impact the value of the site as well. So best not to get into overheated, booming, stupid markets, because that is the best way to get taken out when the market turns. That's regional Queensland. Same goes for Darwin. It's hit a bit of a top and started to stagnate, as history doesn't repeat exactly, but it rhymes. If we look back at history from 2006-7, it charged all the way up to 2013-14 and then topped out and then went through a downturn. And it's not experiencing that same boom like what it did historically. I suspect because this time around, China is not building as aggressively as they did pre-GFC. Their construction property industry is not as booming. They've got a lot of pressure from the US. So their economy is not as strong and is actually quite fragile. So I don't believe the likes of Darwin will experience the same boom like what it did from 2007 to 13, 14, as times have slightly changed. So Darwin, when the market does turn, could well go through another downturn before experiencing a boom like what happened during the GFC and post GFC. Regional New South Wales topped out around 22, softened and is now started to stabilize, showing signs of stability, and will probably go through a similar growth path, stagnant, flat period, just like what happened from around 2006-7 to 15. So no rush on certain markets in regional New South Wales. Regional New South Wales is a tricky market to pick. Not every region performs the same. It's a big state. So the Northern Rivers perform similar to Southeast Queensland. This is more central regional New South Wales. And the south of region also performs similar to the likes of Victoria. So the land market doesn't know where a state starts and a state begins. It works collectively in a region. So had some comments saying regional New South Wales is still booming in the Northern Rivers. That's because it's close to that Southeast Queensland region. So yes, it is regional New South Wales, but within that same region, such as the likes of Grafton, the likes of Lismore, Byron Bay, are running similar to Southeast Queensland versus this is orange. So each town runs at different times of their own cycle. If we look at Hobart units, topped out around 22, went through a downturn, showing signs of stabilizing. Similar to what happened in 2006-7, could well go through another stagnant period before experiencing another significant bull run in the years ahead. Same goes for regional Tasmania, topped out around 22, went through a downturn, has since stabilized and starting to stagnate, and will continue to stagnate, similar to what happened from around 2006-7 for a good 10 years before experiencing another significant bull run. So definitely time on Tassie. Regional Victoria houses had a solid run in the second quarter of the current cycle from around 2015, 2016 up to 22 off the back of Melbourne. Then topped out in 22, went through a downturn, starting to show signs of stabilizing and starting to stagnate, and will continue to stagnate for a good 3 to 8 years, depending on which town you look at. So there's definitely a lot of time on regional Vic. I know there's buyers agents pushing people into those markets, but they're not across this stuff. I had a question from a client or prospective client this week and asking me what separates me from other people. There's a number of items that separates me, but this type of way of thinking separates me from, I think, every buyer's agent in the game. None of them are across this stuff to the detail I am. Maybe one other is, but they don't use it probably as accurately as I would, as they're still buying in Brisbane. But some of the big guys are pushing people into regional Victoria, and unfortunately, they'll be buying assets and pretty much will getting next to no growth for a good 4 to 7, 8 years, especially the likes of Shepparton. that market's going to stagnate for a good 8, 9 years before experiencing another growth run. So sure, you can go buy a cheap house, but it'll be cheap in 8 years' time as well. Same price, if not even more suppressed. So time on Victoria, regional Victoria, Sydney units has been stagnating since the market topped out around 2016, 2017, is due to continue to stagnate, but the boom is on the horizon, just like what happened from around 2008-9 all the way up to 2016, 2017. Same goes for Melbourne units. Melbourne units, depending on which market, what suburb, what price point you look at, this market is pretty resilient and has already started. I believe Melbourne troughed out in late 2024, between August to October 2024, Melbourne bottomed. Melbourne's starting to rise. Green shoots are starting. And green shoots are quite interesting because a green shoot will start at a certain price point with a certain type of product in a certain suburb. Green shoots start. As an example, we've been buying in Melbourne between 200 or 190 at the start to 200 to 350K. And when we first started getting in, year and a half, 2 years ago, those people are now refinancing their properties that they bought for high twos, low threes for 450K. So they're getting a solid 100 grand cash out of them within 6, 12 months to then reinvest again. But that is a green shoot. When a green shoot starts, it'll start from a certain price point, certain product, certain suburb, as there's not one property cycle. Each state, region, town, suburb, property type, price point, all perform differently at different stages of their own cycle. Something to think about. So it's not just a blanket rule, okay, go and buy anything in Melbourne and should be right, mate. It can be the complete opposite. So buyers beware. There's not everything that will work, especially if you want to buy properties to build a portfolio and become the 1% of Australians who own 6+ investment properties. Less than 1% own 6 or more. 25,000 people in the whole of Australia. So if you want to join that 1%, happy to help. And buyers beware of these markets. Adelaide, South Australia, they're hitting a top market peak. Perth, WA trailing behind in the FOMO. Brisbane, regional Queensland, they're in classic FOMO state. That final year or two of overheated, stupid money is pouring in because the yields are there, but the rents can also soften. So when the rents soften, then so will the asset value. So buyers beware. I'm going to be selling out of Brisbane next year, the year after, and eventually I'll be selling completely out of regional Queensland to reinvest into other markets for the next boom years ahead. Meanwhile, all the punters are charging in, buying because they think it's the best time to buy because the Olympic Games and all the bullshit. You need to get into that market 5, 6 years ago. It's just like baking a cake. You bake a cake first, let the market do the heavy lifting. That's building the cake, baking the cake. Once the cake is cooked, you take it out of the oven and then you put the icing on the cake and the cherry on top. That's like the infrastructure. And if Olympic Games is coming, you don't get into a market now because of the Olympic Games. That's like the icing on the cake. You need to bake the cake in right from the start and let the market do the heavy lifting. The market's already priced in the Olympic Games. People have already priced that in. So sure, over the next year or two, we'll get a final sugar hit But when the market turns, it'll lose all that and you'll be in negative equity. So buyers beware of those overheated stupid markets. And the likes of regional VIC is showing signs of stabilizing, but it's not going to take off tomorrow. Will start taking off the back of Melbourne. Melbourne's got a 5-6 years to bull run before regional VIC will outperform. So there's definitely time on regional VIC, even though some buyers agents are pushing people in there. It's unfortunate. Hobart, Tassie, regional New South Wales, there's plenty of time on those markets. They've got many years to stabilise and stagnate out. But Sydney, Melbourne, they're the best markets to buy now to protect yourself of the coming downturn. Come 27, 28, the market's going to turn and it's absolutely going to smash these markets. Adelaide, South Australia, Perth, WA, Brisbane, regional Queensland, Darwin, they're going to get hammered the hardest because they're gone through the final heat. And then the ripple effect will come back. All the mainstream herd, all the stupid money, there's always demand to buy property. All the demand that's currently charging into these markets will come back to Sydney and Melbourne, and Sydney and Melbourne will then lead again in the recovery, just like what they did from around 2007, 2008 and onwards. There's always demand to buy property. There's always demand to buy affordable stock. The demand is going to shift back to Sydney, Melbourne in the affordable stock levels. And then you'll find when the market is going through a downturn, the top end is driving that downturn. So commercial property will get hammered over the next 3 or 4 years. It can lose easy 70 to 80% value. History has shown us through the 2008 GFC, the 91 recession we had to have, 1972, that nearly took out Harry Triguboff, 91, that nearly took out Trump. He had to sell up all his casinos, too heavily leveraged in commercial. 1955, after the post-war boom. 1933, Great Depression. You can keep tracing them back every 18 or so years for the last 200 years. We're due. Come 27, 28, we're due. Big downturn, and every second one's a big one. The next one's going to be like the 91 recession we had to have, and the people that buy into these markets will get the brunt of it. The people that buy in these markets won't see much growth for a good 5 to 10 years, and the smart money is now entering Sydney and Melbourne, and those markets will lead again in the recovery, and away we go. So buyers beware. Get across this stuff, study history so you can prepare for the future. As always, this content is general in nature and is by no means financial advice or general advice. Prior to making any investment decision, you should seek independent advice, independent financial advice, even though most financial advisors don't know shit. But if you want help, shoot me an email, send me some feedback. Happy to jump on a call if you want to proceed with me and helping you build your portfolio and navigating through these turbulent times ahead. Happy to help. It's a great time to buy property. There's always deals to be had. It's just getting the right deal in the right market at the right price point and riding the next wave. We can jump on a 2-hour strategy session. We can map out the plan for the next decade to get you to a 10 plus property portfolio, which is basically what I would do in hindsight. The people I'm helping today are doing a lot better than what I did, as they have the benefit of hindsight. This wasn't all thought up and mapped out overnight. This is my 15 plus years of construction, property development, and property investing experience, jam-packed all into one slide pack and slideshow for you guys to help you navigate through the markets to become part of the 1% of property investors and achieve financial freedom. Until next time, thanks for watching.